All right, welcome to the fourth video of this bootcamp series going over liquidity. Now, before we dive into it, let's define what is liquidity. What is liquidity? What's the whole purpose of it? Now, liquidity in trading is the availability of buy and sell orders in the market. It shows how easily price can move without big slippage. High liquidity equals smooth movement, tighter spreads, like in major forex pairs. Now, low liquidity equals choppy movement, wider spreads, especially in exotic pairs, penny stocks. Uh, so that is liquidity in trading. Now we're looking at liquidity in market structure. Liquidity in market structure. Today we'll be going over that. Liquidity is often where clusters of stop losses and pending orders sit and highs, higher highs, lower lows, equal lows. Uh, this is where you can spot liquidity, aka money. And one of my favorite questions is to ask myself when I'm diving into this is where's the money? Where's the money? You want to spot where the money is in the markets. Institutions and smart money often target liquidity pools to fill their large orders. And we'll be going over some examples here to show you guys and to spot these liquidity pools, right? So here we can actually look at the dollar index. We can spot an imbalance here. This is liquidity. All of these are sell orders that push price down. This is considered liquidity because we have sell orders that were pending and it pushed price down, and now price buyers are now taking over, taking control over the market and are stopping people out, and they are taking out the stop losses from these sell orders. Now, this is an example of liquidity, right? This is all money here. This is money. We also have money here. We have money up here from the sell orders from this high, and we also have money here from these highs and here. We can also look here. These are also liquidities equal lows. This is also liquidity in the market. Now price is currently here and is filling up this gap, this imbalance, this liquidity. There were sales that were placed here at this price level and it pushed price down. Now buyers are now in control and taking over, and they're filling the gap of this imbalance, and they're wiping out the liquidity and taking out the stop losses. So just think about this. People were placing sell orders up here at this price level. They're setting up the stop losses, placing their sell orders. They're placing the sell orders here, the stop losses, pushing price down, and now buyers are now taking over and filling up this gap. So some traders are still in the sell position, or there are some sell uh there are still some sell orders that are open from these sellers. So if I was selling in this position, I would have been closing my trade. I would have been closed for my position. I wouldn't keep my position open because now buyers are taking over and now price is coming back up to fill this gap. So I would have been closed out for my trade, right? When I see this happening. So anyways, That's how you can spot these liquidity is when you see where you see big players are active. This shows huge this huge bearish candles showed where big players were active, right? The institutions came in to enter this sell order, pushing price down, creating an imbalance. And now uh, these traders are now exiting their trades because now buyers are taking over the market. They're now in control and they're pushing price up to liquidate, to take out the sellers from the market. Now there's also uh, situations where you'll get fake outs in the market. And I can show an example here of a fake out. See here. This is a fake out here. We have a resistance here. At one point, we thought that price was going to break above this resistance zone, this resistance level. Price at one point was trying to break above this level, but instead it resulted a continuation to the downside. So price failed to break above, and instead it reversed back down for the continuation. You see this bullish candle here was a fake out. This bullish candle was a fake out. You see how price broke below, came back up to retest. However, there were some traders that were that some saw this bullish candle and they were thinking, okay, I'm going for a buy because I see this bullish candle and prices broke below this resistance level. Now I'm going in for the buy. But no, they failed to realize that after there's a breakout structure, you want to wait for that retest as well as that confirmation candle and other confluences to indicate a successful trade entry. However, just by this information alone is not a successful entry because you don't have enough confluence to enter that trade successfully. And instead, it resulted a fake out and pushing price to the downside because of this candle. So you see situations like this happening, resulting in fake out. Why? Because we have liquidity here. We have liquidity here from these sell orders. People were placing their sell orders or stop losses up here for the sell. Price came back up and eventually took out and liquidated the stop losses. It results in this huge engulfing bullish candle to wipe out the liquidity from these sells, these stop losses. So some traders were selling here, had their stop losses set up here, and eventually price came back up to this level again and liquidated all these stop losses because this was a fake out, resulting in continuation to the downside. And also, there were some traders thinking that it was going to turn bullish, a continuation to the upside, break above this level, but it created a fake out because of this candle pushing price to the downside. So there are some people that are placing buys here. They're placing buys here because they see a break of structure here as well. You see a break of structure here. So there are some buyers here. People were placing buy orders here, thinking that I was going to continue up. When you go down in time frame, when you go look at the 15-minute here, you see this was a fake out. People were thinking, oh, it's going to continue up because we see a break of structure here to the upside. Price broke above, retest, and then create another higher high here. Price broke below, above, and now it broke above this high here, this previous high, resulting, thinking that it was going to continue to the upside. They placed their entries here. Price was in profits, but it failed to continue to the upside, and instead it reversed back to the downside, hitting the stop loss. So this is a prime example of a fake out in a liquidity sweep. So you do not want to enter when you see this happening. You have to wait for other confirmations for a successful trade entry. By this alone does not mean that, okay, I see break of structure, I see a continuation, I see a slight continuation to the upside. You need more evidence, you need more confluence before you enter this buy or sell order. That's why following each step is very important because you spot the liquidity. Yes, you spot the liquidity. You spot the liquidity, right? This fake out resulted because there was liquidity back here. There's sell stops, sell orders up that back here. That is why it resulted in this fake out. It was a fake out. It was a liquidity sweep. People were selling here. There are a lot of sell orders here. People were selling, selling, and there's buyers pushing price up, but it resulted in a fake out for the continuation to the downside. Now, yes, you want to spot liquidity, and after liquidity, now you gather the confirmation candles. You look for confirmation candles to see if it's going to continue to the upside or to the downside, or it's going to reverse on you. It's so important to keep this in mind, guys, because I've had many mistakes throughout my years. Over 5 years of trading experience, I've seen fake outs, I've seen it all. And it's all manipulation at the end of the day. So you wanna implement smart money concepts and trade like the banks. Have that mentality like a banker. Have that mentality. Don't be the average retail trader. Don't be the average trader because you will lose. You want to observe the masses and do the opposite. Most people are selling here. You're not selling there. You know that that's a liquidity buildup. You know that there's that is the location of liquidity. You see that most people are selling here, most people are buying here. Okay, I'm gonna observe them. I'm gonna observe and look for that liquidity. I'm gonna go against that. I'm gonna go for that liquidity because that's where big players are active. Institutions need liquidity to enter or to exit. I repeat, institutions need liquidity to enter or to exit. So here, the big players saw an opportunity here to liquidate these cells. So that is why I created this fake out. They, instead of going for a buy, they went for another sell order because they look for an opportunity to liquidate these sellers, and here for a potential entry for a sell. And it can work both ways, right? For also exit. You see here, this is another example for buys. This is liquidity here. This is liquidity here. Buyers came in. Liquidated these buyers. It was consolidating. It was liquidity buildup. Push price down to liquidate these buyers for the continuation to the upside. An exit up here. Why the exit up here? Because there's liquidity here. See? So it can work both ways. Big players are active. Institutions need liquidity to either enter or exit. So they look for they spot for liquidity for an entry, and they also spot liquidity for an exit. Just like this example. They spot liquidity here, this buildup, they spot liquidity here, they push price down, they push price down to liquidate these buyers, and they push price down to then enter here. And this is a confirmation candle right here. This is a confirmation candle. Let me remove this here. It's getting a little bit messy here. I'm doing a lot of drawings. Just bear with me, guys. So here you see there's a confirmation candle. This is what is this? There's this could be considered a morning star. Yeah, this is a morning star. This could be considered a morning star. This is a morning star right here. This is a morning star. So when you see this candle, this doji candle right here, it's a reversal to the upside. Buyers are not coming in. There's a loss of sales. Sellers are now uh, weakening. They're not under control anymore. Buyers are now taking over, and it's causing a reversal to the upside. This is the liquidity sweep. Push price down to liquidate these buyers, these orders, and institutions came to enter, and they set their exits up here. Why? Because we also have liquidity here. You can use this as an exit price as well. And they re-enter, they fake them out, they liquidate it up here, and they exit their buys and they enter their sell orders. So you see the trend, you see how they play the game. They look for liquidity, they look for liquidity sweeps, either for buy or sells, they look for that. It's you guys can see it here. They liquidated twice. They liquidated here, boom. They liquidated here, poof. For the buy up, the exit, because they have liquidity here. They created a fake out. They liquidated those buyers as well, thinking that it's going to continue up, but no, it's got to trade with the trend. Trade with the trend, right? And they went in for that sell to maximize it. Institutions and smart money often target liquidity pools to fill their large orders. So in this example, you see price spiked above the equal highs to take out the stop losses, and then it reversed down. It spiked up. You see in this fake out, it spiked up to take out the stop losses here, and then it reversed back down. Or price dips below the equal lows, just like in this example, in this buy, to grab liquidity before it rallies up. That's exactly what happened here. Price, uh, the institutions push price down to liquidate these equal lows to take out this liquidity before the rally up. And then price spiked above the equal highs here. Price uh, pushed up, it spiked up, and it created a fake out and take out the stop losses here, and then it reversed back down. Why is it important to look for liquidity? Well, it shows where big players are active. It explains fake outs. Stop hunts happen because liquidity is being collected. And it helps traders anticipate moves. Instead of being trapped, you trade with the smart money. So spotting liquidity will help you as a trader. It will help you. It helps you to anticipate these moves instead of being trapped like most people and being liquidated. Now, liquidity equals fuel for price movement. Price often seek liquidity pools above highs, below lows before making its true move. So this is very, very important. This is a very important concept to learn. It's liquidity, spotting where the money is at. Ask yourself, where is the money? Where is the money? Look for liquidity. When you guys look at the fourth step of this playbook, spot liquidity, spot where there's potential moves, where price could potentially go. You see here, currently price is here, and now we have this huge imbalance, meaning this huge liquidity. Prices now is coming back up to liquidate this. So you want to gather as much confluence, look for liquidity to see where price could potentially go, so that way you can anticipate it and you can enter or you can exit from your trade. Now, appreciate you guys for tuning in. This is the end of the video. Stay tuned for the next video. And I'm so glad that you guys are watching this bootcamp series, because this blueprint, this game plan will change your trading game. It will give you a better idea on how to navigate the markets, how to confirm your analysis, and that is how you'll become successful as a trader. I'll see you guys on the next one. God bless.